Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Wednesday, May 13th. Trying this today from my garage where I can actually fit the background nicely. You may hear a couple of birds chirping outside, which is a good thing. It's a beautiful spring day here in Connecticut. But not necessarily so much if you're trading the markets, at least if you're long the markets. Basically, we closed yesterday in a fairly ugly manner. Again, I'm speaking if you're long, and since most people are investing from the long side, that's going to be the way I'm going to talk about it today. It ended in a fairly ugly manner, and I did get a couple of questions. Geez, what happened at the end of the day? And my sort of snide remark is, whoever was working the air pump seemed to take a little break in the last hour, because we just sort of faded away on nothingness. This is the kind of move that you get in the week before expiration, or more likely to get in the week of expiration, as you cross through strikes. And we've explained various times about, sometimes you're long gamma, and that's good where you're buying and selling, but sometimes, where it forces you to buy low, sell high. Sometimes you're short gamma, where it forces you to sell high and sell low and buy high. Not a pleasant situation. And as markets cross through strikes, that effect gets magnified, particularly as you get close to expiration, where there's concentration in certain strikes, and moves kind of pick up a little steam. And I think it was just sort of a little preparation for Powell's remarks this morning. I think people did not expect them to be all that friendly. I think there was a bit of a delayed reaction to Dr. Fauci's comments, although they happened earlier in the day. And again, I think yesterday, a certain number of people were distracted either by Dr. Fauci's comment, Dr. Fauci and the other doctors testifying, or the Supreme Court testimony that was going on, which really wasn't market related, but just interesting if you're a student of history and politics. And so this morning, though, was really the big kahuna was Dr. Powell, Chairman Powell, speaking at 9 o'clock this morning before the Peterson Institute of International Economics, and a lot of the talk got around negative rates. And I think that's why you've seen the banks underperform so much recently. The spread, and I think this raises a big question for where the market goes. Over the past week, we've seen Fed funds futures start to price in negative rates for, let's say, about 6 months to about 18 months as on the Fed funds futures curve. That's not something that I think is really a good sign for America. If you're addicted to Fed liquidity, sure, the more the Fed provides liquidity, the better you are. And the stock market, to a certain extent, is acting with what I'm going to say is addict behavior. They're just addicted to this Fed liquidity, and anything that offers Fed liquidity seems to be a good sign. But this, to me, is one of these careful what you wish for moments, because if we're looking at negative rates, say 6 months out and beyond, and the stock market tends to discount 6 to 12 months out, what is that telling you about the economy? And yes, you can make the argument that the leadership in the stock market is not the economy as a whole. And over time, basically, you can't really divorce the two. If you have a crappy economy, the stock market's going to follow. If you have stagnation, the stock market's going to follow. And if the economy is so lousy over the next 6 to 12 to 18 months that the Fed needs to go negative, what is that doing for you? That's really not telling you a good economic picture. I think that's why Chairman Powell kind of threw some cold water on the idea. That said, looks like the Fed funds futures, try saying that 5 times fast, Fed funds futures market really hasn't moved all that much, and they're still pricing in some negative rates. Pretty much do as I say, not as I do, or I don't know, some sort of act of defiance. It's very, very hard to say why the market sort of ignored that input from the Fed chairman, but ultimately, maybe they think they could bully him into it. I really don't know. It's just one of these mysterious kind of features that it's just so hard to tell what's going on out there right now. And I think it, again, sort of shows this addiction to liquidity, and not in a good way. What the Fed funds futures, and I'm incorporating a chart to show you this, are really not telling you anything that you want to see right now if you're bullish on the economy. And for those of you who are saying you're going to get a V-shaped rebound, well, when? This is not telling you that. This is telling you that there's negative rates out till pretty much all of 2021. If you're getting a V-shaped recovery in 2021, why do you need negative rates? So there's a real disconnect there. And again, over time, when there's a disconnect, I think the bond market tends to get it right, not the stock market. And the problem now you have is there's pretty much two separate stock markets. There's the overall broader market, sort of as measured by most of the S&P, and I'm going to call about 80% of the S&P. And after attempting a brief bounce this morning, they've given back some of the, they've given pretty much back all of that and then some. And then you've got what I'm going to continue to call the Magnificent Seven, which for the most part, those stocks are acting well. They were all higher at one point this morning. You know who I'm talking about: Amazon, Apple, Google, Microsoft, Netflix. Those represent 50% of NDX. So you really almost have to separate NDX from those NDX leaders from the rest of the market. Let's see where this takes us over time. Right now, I think the stocks that are a bit more economically sensitive are telling them the picture that the Fed is giving. And then there's a subset of stocks that are just continuing to follow the money flows and have momentum of their own. And, FOMO still reigns. Let's see how this all plays out over the coming sessions.